I'll come back out from behind the podium after that introduction. Thank you very much, Ian. And I didn't pay him for saying that. So look, brilliant to be here this morning. It's been a decent year for the housing market. I think what Ian talked about, the strength of incomes growth, the strength of maybe we've got actually a stronger labour market has really fed through into what's been quite a decent kind of rebound for the housing market. It's certainly it's been good news in terms of the sales pipeline that agents have rebuilt. So I just want to look ahead to what's happening, what's going to happen for those eagle-eyed readers of The Negotiator and other magazines, and hopefully our emails this morning. You'll have seen our latest house price forecasts have been published today. But I really want to focus on also, as we go through this, on what I would be doing if I was an agent. What would I be focusing on to sort of try and get ahead and make sure I stay ahead in 2025? And I want to look at the sales market first, and then have a look at the lettings market, because I know it's a really important part of a estate agency and what landlords are going to get up to in the next couple of years. So I think the main forecast for the sales market is we just think this momentum that's really picked up over the second half of the year is going to carry on into the next year, despite the budget headwinds picking up on that final point from Ian. And we think actually house price inflation is probably going to end this year at about plus 2%. I just think that's going to carry on into next year. There's still some pretty strong incomes growth kind of forecasts coming through for next year. And I think also lenders are going to be really big pressure to grow lending. And they're going to do some things in the background that aren't talked about a lot that are going to sort of support people's ability to both move and pay. We don't want a ton of house price growth. We just need enough house price inflation to give people the confidence to make offers on property and for people to think that they can actually afford to move, and we need to get more people moving. So, as with all my presentations, if you haven't seen one before, lots of slides just to sort of tell you the story. These will be available afterwards. This one here is just an index of how many sales have been agreed on a rolling weekly basis. The key message here, if you look at the sort of this year to date, is we're well ahead of last year. We're actually almost as strong as we've been at the end of 2021, which is a bit of a busy year for the market, and we're ahead of the pre-pandemic period. So sales are up 20% year on year, and the pipeline of deals going through to completion is 30% higher in value terms now than it was a year ago. And that should translate straight through into sales commission for agents, lending opportunity for lenders. This also supports house builders who are a bit uncertain about where the market's really going. But I think some of this momentum is definitely going to carry through into the first half of next year. You know, deals agreed today are going to be completed next year, and that's when the revenue comes through. I think the other point here is, inventory is also recovered. This is the total average number of homes, unsold homes for sale per estate agent on Zoopla. Pre-pandemic was averaging around about 30. Obviously, we had stuff flying off the shelves over the pandemic in 2020 and 2021, but that's steadily recovered. This is a mixture of sellers. I think, a key feature that we've all been talking about is how many landlords are selling. We find that around about 12% of these homes were previously rented out in the last couple of years. That's a much higher number in central London. I think, higher mortgage rates have really hit sort of landlords. So actually most of this landlord selling we find is in London, the southeast, where yields are lower and the kind of returns are more challenging. It's lower in other places. And look, the good news also is this is a load more homeowners that have put off moving decisions over the last couple of years with the uncertainty of higher mortgage rates, higher base rates, just general uncertainty, just coming back into the market, wanting to move. In second home markets, with some of the tax changes there, we're seeing a bit of an above average increase in supply as well. So look, government policy, taxation does lead to more buying decisions, but again, if you're in the business of buying and selling property, more inventory, and as long as we have serious sellers and committed sellers, is net good news. So I think this more supply is going to be a feature of the market next year, but this also means sellers, if they're serious about moving, have got to be realistic on the price. The other big feature in the market, and this is a chart showing you the percentage of sales this year in the dark purple. The light purple is last year, and then the 20-year average is the grey bars. Look, first-time buyers are a really important part of the market. Over a third of transactions are going to be first-time buyers. As mortgage rates have fallen to 4%, as rents have absolutely rocketed, as you'll see in a minute, that's really forced the hand of a lot of first-time buyers. But to be a first-time buyer, you do need to access the bank of mum and dad. The average deposit is 20%. We'll talk about first-time buyer affordability more in a minute. I think the more challenging area for us all, if you want more vendors, we need to get that second group, the existing homeowner with a mortgage, we need to get them moving more. We've got to get them to believe they can move, because affordability pressures are really getting them thinking hard about, should I just take some more money and stay where I am, or should I actually move? And for a lot of people, we're seeing now is people having to look further afield to realise their moving ambitions. And if you're moving out of area, you need more help from both your agent, from the industry, from people like ourselves in helping people's decisions become a kind of reality. Yes, you can afford to move home. The other big group is cash owners. Cash is about a quarter of sales. That's a mixture of owners and investors. I mean, it's a big number, but it's not a big number when you think that more than half of homeowners own their home without a mortgage. So, they're just not moving as often as they should. And then buy-to-let with a mortgage is the final group. Look, we still have we had about 20,000 buy-to-let investors buying properties a month with a mortgage in the sort of 2014, 2017 period. It's about 10,000 at the moment. So there are still people buying property. There just happens to be about the same number selling property, basically, who didn't really see it as a business and decided to leave the market. So look, landlords are still buying, and they're under 1 in 10 purchasers. And I think if we rolled forward to next year, I think this chart might well look broadly the same. But I think the opportunity is getting those existing homeowners to believe they can move, because their share of sales has been falling and falling and falling. And again, for them, it's should I stay, take money on my mortgage and improve my home, make it bigger, or is there an option to move? And I think a particularly important point here about upsizers is, and when we look at the data we have on upsizers, nearly 40% now want to move out of area. So, housing, a lot of moves happen in a narrow area. They want to move out of area. And again, just to think about how you write your property descriptions, they're almost prepared to move if they can find the right features in their next property. So again, we've got to really think about when we present property, thinking about actually what does someone from further afield really want to see in their property to encourage them and get them to move. So more sales, lower mortgage rates has actually fed through into a pretty decent firming in house prices. There's not a boom underway, but this is the position in house price inflation a year ago by region and country of the UK. Prices were generally falling, apart from Scotland and Northern Ireland. And actually now, year on year, we've had a pretty decent sort of widespread recovery in the housing market. So house prices are still rising more slowly than incomes. I mean, again, incomes growth this year might be 4.5%. House prices are up by 1.5%. Northern Ireland, there's a lot of, I'm not going to go into Northern Ireland, but there's reasons for that. It's just underperformed. We've sorted out the post-Brexit trading arrangements. The economy's doing better. House prices are recovering. The key message here is, I think in the southern England, house prices are sort of just barely positive. They're lagging behind. There is an affordability challenge in southern England. And again, if I say house prices are going to rise 2.5% next year, we're probably going to have this similar kind of spread, a little bit of underperformance in the south, slightly better performance in kind of regional housing markets away from southern England. And again, do read our house price index report where we can look in detail at affordability, because it's really shaping the kind of dynamics of the market. But I didn't think we'd see this year. I think there's two reasons we were wrong but right. Number one is just this incomes growth. I mean, last year, household disposable incomes grew nearly 10%, if you believe the OBR. It was less in real terms. So, really strong incomes growth has really helped with affordability, and then mortgage rates coming down has also helped. Now, one of the reasons prices are firming is buyers are prepared to pay a bit more of the asking price. So this is a time series we run with our colleagues in HomeTrack, who are a data business as part of the wider group. And it just shows for the rest of the UK, in purple, London, the South East, over time, what percentage of the asking price was a buyer paying. And so in that sort of Brexit uncertainty, 2018, 2019, the discount was 3 to sort of 6%. Then we had obviously the pandemic boom. People just had to pay the asking price, basically, particularly there across the rest of the UK. And then as soon as we had the mini budget in 2022, interest rates started rising. People got very nervous. All of a sudden, we shifted back into a buyer's market. Prices obviously falling last year because we got down into the sort of 4-5% discounts. But again, you can see that firming in prices. Buyers are coming back into the market. They're more confident about making offers. Sellers have still got to be realistic. It's still a buyer's market out there. It's still going to be a buyer's market next year. But if you price correctly and have the right property, it's going to have a decent chance of selling. So I don't really see this changing significantly. In terms of first-time buyers, and I just want to reiterate this point about affordability because it's really, really important. I think there's a bit of a negative chart I'm going to show you, but there's a positive silver lining, I think, that's going to kind of support the market next year. So I'm just looking at, we're all renters. We want to buy a property. And I've converted all this into the income you need. I could have done it in rental payments and mortgage payments, but I've converted it into a household income to give it some more context. I've also just focused on the south of England because that's where the affordability problems are. And I've also just lumped the rest of the UK together because the numbers are broadly the same. But this is the income you need to be a renter. So about 30,000 in the rest of the UK, going up to nearly 75,000 in London. This is the income you need to buy a typical first-time buyer property with a 4.25% mortgage at 80 loan to value. So look, renting and buying, broadly the same, actually even slightly cheaper, as long as you can come up with that 20% deposit, which is the kind of UK average at the moment. The challenge is, and it was a good move by the Bank of England in 2015, they could see a problem brewing that if everyone bought homes on 1.5% mortgage rates, it would probably lead to a massive boom in house prices that would need to correct as mortgage rates went back up to what we now know is 5.5–6%. So they introduced some rules to say that whilst you can pay 1.5% on your mortgage, you have to prove to your bank you could afford 6.5 or 7. It's called mortgage affordability stress testing. It's still there today. And that just creates a bigger hurdle for people because actually a first-time buyer who's a renter wanting to buy has actually got to prove to their bank they can actually afford this grey bar, an 8% stress rate, to actually be able to buy the property. And what that does is it just means the income to buy a property is just much higher, basically. So this is a kind of real challenge, and this is one of the reasons there's such strong demand for rented housing, but it's also one of the reasons that house price inflation in the south of England has really struggled, because as borrowing costs go up, it kind of more people get priced out of the market. I think lenders are going to be really innovating around this. I think over the next 18 months to 2 years, they could be, all of them could be at less than 8% today. They just need to kind of work it through and persuade the regulators that it's safe to do so. I think it could go down to 6.5%, maybe even 6%. It's not going to close the gap completely, but it's definitely going to help marginal first-time buyers help to buy a home. Because if it doesn't go down, it just means that first-time buyers have to be on quite big incomes and have big deposits to buy. The way to get around this stress testing is you need a big income. So this is the average. These dots are the average income of a first-time buyer last year, up to 100 grand nearly in London, 50,000 across the rest of the UK. In the southern England, somewhere between sort of 60 and 70,000 pounds. The bigger challenge is the deposit. The average first-time buyer deposit last year in London was 150,000 pounds. That's a 33% deposit. And it's all because of regulation. You might have heard a lot in the papers about how regulation is sort of having an impact on the economy. This is what's happening in the background. This is great from stopping boom and bust. It's one of the reasons I'm up here saying the housing market's actually bounced back. But what we've really done is we've capped buying power with all these regulations. I think there's definitely a case that lenders will reduce this, and that's definitely going to help first-time buyer numbers next year, which is why I think first-time buyers are going to be a decent market. I think the challenge for us all is first-time buyers have got nothing to sell. We also need to get the sellers into the market who are homeowners equally as helping first-time buyers. The other challenge, which wasn't really in the budget, bit annoying really, but obviously when Kwasi Kwarteng had his budget, he loosened off stamp duty. That's now ending from next April. So look, more people are going to pay more stamp duty next year from April. So currently about 20% of first-time buyers pay stamp duty. That's going to go up to 40%. It's going to hit southern England around the M25, and in that sort of 300 to 500,000 first-time buyer price band. They're all going to pay a little bit more, which means they're going to pay less for property, which is going to keep an edge off prices. But home movers, the 2% band is coming back between 125 to 150,000 pounds. Sounds like the house for a working household or a working person to me. But anyway, they're going to all pay up to 2.5 grand more next year, which is 1% of the value of their property. So that actually hits markets in the Midlands, the north of England, where a lot more sales are between 125 and 250,000 pounds. Stamp duty is a bad tax. There's a whole presentation about it. But again, unfortunately, it's turned into a massive money spinner for government. All these changes are going to get it back up, probably into sort of 15 billion. It's just going to keep on rising. And again, the more we shout for stamp duty reform, you've got to be careful what might come in its place to replace that 15 or 10 billion pounds. It could be wider property taxation, which hits a different part of the population. So this is just a bit of a drag on the housing market, and again, it's going to be a bit of a drag on house price inflation. So in terms of these vendors, just a couple of thoughts on vendors, and this comes into kind of what could you be doing within the sales market. If we just look at LandReg data by region on how long has the average seller in the last 3 years who's sold been in their home, it's the magic 7-year rule. It's 8 years in the south, and that's how much money they made on average between when they bought their property and sold it. So the average seller in the last 3 years has made £60,000 and been in their home 7 years. It does vary a bit. Worryingly, these sellers, particularly in the south, are making a little bit less money now. But that money they're making is important because it unlocks the next move. But if you're making a little bit less money, you're going to look further afield, basically. And again, as agents with branches, we can't just focus on our micro market. And I'm sure many of you do, but we've got to keep looking that little bit further to find those applicants and helping those vendors actually find their next property to turn them into a vendor. Interestingly, on that chart as well, I mean, the average when someone remortgages and takes money out of their property to do it up, it's £60,000. So the sort of £60,000 number is a kind of a magic number. But again, we need to be thinking about it from a vendor's perspective. If we break that out over time, this is looking at the last 3 years of all the sellers. This is how long they've been in their property. And you can see 2 peaks here. There's a peak at 3 to 7 years when a third of sellers in the last 3 years have only been in their property 3 to 7 years, and that was between Brexit and the pandemic. And again, my question to you, in the nicest possible way, is just how much are you hitting your recent buyers and sellers and talking to them about the market and what's happening and keeping your kind of brand front and center in their mind, because it's pretty important with these sort of people moving more regularly. And then look, there's a classic lifestyle move. I think that spike in 16, 17, 18 years is probably linked to kids disappearing from home, wanting to change kind of where you live, etc. So a real message here in how and when you prospect on your back book, particularly of your customers. Just because you've made the sale, it's been a nightmare to get it through. Don't stop communicating with them. And then on the moving out of area piece, this is some work we've done on how far are applicants looking for the next property. And again, the general rule of thumb is, 80% of people move within 5 miles. Well, actually, that's changing now. Affordability is a big pressure, as you can see. We've got changing working patterns. So again, in the east, for people who are applicants who currently live in the east of England, the southeast, nearly half of people are looking more than 10 miles for the next property. Now, if you're an agent in that receiving area, you're going to, are you marketing widely enough to capture those people? And again, it's people with higher value properties that tend to look further afield. So they've probably got a bigger budget. So for all those 4-bed houses you might be struggling to sell, are you really looking widely enough? Clearly, portals have got a really important role to play with that, more targeted marketing products, etc. But I think this is going to be a continued theme about getting those homeowners moving, because if we don't get vendors to be an applicant and a buyer, then they're not going to put their house on the market. So we've got to help on both sides of the equation. Overall, again, we think housing transactions are going to be up by about 5% this year to 1.15. That kind of momentum is going to carry through. So look, it's a pretty decent outlook. The key risks probably to us all are probably more global. But as Ian said, I think there's a challenge that I don't think mortgage rates are really going to fall a huge amount next year. But if we've got a strong underlying economy and jobs market, that's going to be positive for the sales market. On the lettings market, the supply-demand imbalance isn't going anywhere. I'm sorry to report that there's not going to be a massive surge of buy-to-let investors piling back into the market, but I do think we're a long way through the adjustment process for landlords, and I think we're a long way through the adjustments. I don't think a lot of landlords are going to be rushing to exit, because most of them that have wanted to do that have probably done so. Rental inflation is going to slow because it's been running pretty hot, but it's still going to be healthy. So for those of you with letting management businesses, you're probably going to see 4 to 5% rental inflation next year for new lets feeding through into your back book. The key thing in the rental market is the private renter sector just stopped growing when those tax changes landed in 2016, and that's what this chart shows. The total number of private rented homes in Great Britain stuck at about 5.5 million. So that's my point earlier. Landlords coming in, because there's still landlords buying, there's corporate landlords buying, but it's just been offset by those selling as the sector kind of rationalizes and consolidates. The other key trend, which is important for where you go prospecting for landlords, is The simple message here is that 50% of private rented homes are owned by landlords, the 20% of landlords with more than 5 homes. And I think that's the bit of the market that's going to keep growing. And the more your book is one-person landlords who didn't really treat it as a business, you've got to persuade those small landlords that this is now a business and you'd love to help them grow their business. But actually, again, the growth, I think, is going to come in the corporate landlord market. The people that have been hit are those with high LTV mortgages. So this chart just shows you the mortgage profile of private landlords. 40% of private landlords haven't got a mortgage. So, all this talk of mortgage rates going up and people exiting, it hasn't been hitting them. There's about a third of people with small mortgages, and they've had the pain of higher borrowing costs, but it's not as bad as that purple segment. About 30% of landlords over 50 LTV, they're the ones that have really been squeezed, and again, particularly so in London, the southeast, where yields are lower. So again, it's really a message that there's not a massive exodus, but there has been more than a steady trickle. As I think we're largely through it all. I think stronger rental growth is certainly helping. And again, you can look at these slides, which will be sent out in your own time. I think this is just a quick snapshot of how much rents have gone up in the last 3 years. Gross yields are improving, and I think gross yields are going to go higher over the next 2 or 3 years. I think rents are going to go faster than house prices over the next 3 years. And that chart there has got the maximum loan to value that a higher rate taxpayer could take at the moment. So again, in most regions outside the south of England, you can still make a 75 LTV mortgage work. In London, it's improved from being in the 50s to now 64, 68%. But again, if you put yourself in the shoes of an investor, that's a lot of equity you've got to put down to buy a property, which is why I think we're not necessarily going to see a huge surge of investors coming in. The investors who are coming in, that they're seeing this as a cash flow business. You don't want to put a lot of debt in. It's about how do I grow a really decent income stream, and that's where the growth's coming from. And so that lack of growth in the sector's had a drag on rental supply. The average number of homes for rent per agent on Zoopla in the rental market is still about 30% below where it was before the pandemic. There's a lot of demand soaking up what is available, but we just haven't had a huge amount of net new investment coming in. Demand is definitely cooling. We had the numbers yesterday of a revision up to nearly 1 million on net migration. Where do 1 million people turning up in the UK go? One hell of a lot of them are going to go into the rental market, and this is why we saw this huge increase. This is the number of inquiries per rented home for properties for rent on Zoopla. Pre-pandemic, we're just under 10, got up to 30, 40 or so in 2022, 23 as the economy reopened. It slowed to 16. I think it's going to stay in the sort of 10 to 12 zone next year. We're still going to have, for various affordability reasons, we've still got a strong economy. I still think we're going to have more people looking to rent, and that's going to keep the pressure up on rents. But rental growth is really limited by affordability now. I mean, it's just a question of how much more can renters afford to pay on their rent. And so what we're seeing at the moment is rental inflation in the big cities is really starting to slow now, because rents have really rocketed a lot in Manchester, Glasgow, Edinburgh. I mean, rents in Edinburgh are 80% higher over the last decade. That's not quite 8% per annum compound. I mean, it's ferocious, basically. So for landlords, there's been some amazing cash flow growth over the last 10 years, but it's definitely slowing in the big cities. But there's a lot of markets where demand is now being displaced because renting is cheaper. And that's when you see rental inflation by type of area, small towns and villages, large and medium towns, we've still got some pretty healthy rental growth. And I think this pattern is going to carry on next year. I think rents in London and the big cities is going to have to be slower than incomes. We might even see rents fall a little bit in the next 6 months. We just slightly overshot on rents, and as demand cools, rental growth will slow. But I still think it's these more affordable markets that will keep rents rising. And look, rising rents is good news for buy-to-let investors' business plans. But again, mortgage rates and the risk-free rates are going to be higher. So just summarising in the last minute or so, look, some key things we've talked about. I think a key message, because lettings is so important to your businesses, that we're largely through this consolidation process. There's a few more landlords that will sell. But again, unfortunately, though, I think we probably need to see house prices fall probably about 10% to bring a whole tidal wave of investors back into the market. So I think we'll see the professionals kind of coming back in the market, and that's the area to target. I think we're going to have enough house price growth to support 1.15 million home moves, but sellers have got to be realistic. And I think there's going to be some support from lenders chasing business. It's not just through rate and margin. They've got to do something about these stress rates to price in more marginal buyers. I think the big thing for next year is all about how can we all as an industry engage vendors. There's a lot of people who want to move, but the question is, how do we make them believe they can move, and you don't just stay put, borrow some more money, do an extension, do the loft. And part of that is helping them move out of area, which is, I think, something the whole industry needs to help with them. And again, my final, real simplistic message is, actually it's amazing when you think a third of sellers have actually moved in the last 3 to 7 years. A lot of you do prospecting, but again, feel free to use our research, to use your own research, use other research. Let's really start educating and communicating with those homeowners, because I think there's a massive opportunity to give people more belief they can move, and that's going to be really positive for the whole market next year. Thank you very much for listening. Enjoy the rest of the conference.